All right, bunch of people joining. We had lots of people sign up, but I think in the interest of time, knowing that a lot of people just kind of wait for replays, I think we maybe we'll kind of get started here. So this is Buck Joffrey, obviously, and um, wanted to introduce to you guys a good friend of mine, my attorney as well, my asset protection attorney as well, Doug Lodmell. A number of you probably have heard him on the podcast before. Um, he's inventor of the Bridge Trust, nationally recognized attorney in asset protection. Um, Lots of different things going on in that arena that he can tell you about as well. But I want to turn it over to Doug. And, this is a great opportunity to learn from, one of the best in the business on this topic. And he can kind of give you a sort of a broad landscape of asset protection and different options that you have. So, Doug, thanks for joining.
Yeah, thanks, Buck. Happy to be here. So, well, usually the place people like to start is just what the heck is asset protection? Um, my answer to that is really pretty straightforward. Asset protection is anything that would stand between you and a creditor trying to reach your assets, a creditor or a predator, any kind of threat to your assets. So, when we start talking about asset protection, we kind of start with two basic concepts. The first is exemption planning, and then the second is legal asset protection. So they're different things, and I'll go over each one of them, and I'm sure that'll bring up some questions. And if anybody has questions, I don't know if this is interactive. Do you
Yeah,
do
it is
interactive?
interacting. And so I'll monitor the Q&A section. So if
Okay.
people have questions, write them in real time and I can kind of, bring them over to Doug.
Yeah, because questions are the best way to learn. So if anybody has questions, I encourage it because I can go any direction you want with this. We could
Yeah.
talk for many hours on this subject, but I'll try to just boil it down to what I think makes the most sense. So when we talk about protecting your assets, there's really two ways you can do it. Exemption planning is the first way. And the reason I like to start there is when you talk about exemption planning, we all already have it. We don't have to do anything new to take advantage of exemption planning. So what exemption planning is it's anything that is exempt from a creditor. And when I say exempt, I mean under state or federal law. So there are certain assets which even the US government and the various states have said, hey, no matter what happens, we're not going to let a creditor take these assets. The most common that everybody has heard of is called your homestead exemption. And your homestead exemption is basically the amount of value in your home that you can keep, even if you have a terrible judgment that exceeds all of your assets, even if you declare bankruptcy. So the homestead exemption is pretty powerful. And basically, the concept behind exemptions are, we don't want people kicked out in their home and homeless over creditor issues. There's a limit to how much we can say you're effectively liable for. So in some states, the homestead exemption is very low, and in some states, it is unlimited. So if you happen to live in one of the unlimited states, then congratulations. No matter how valuable your home is, $10 million condo on South Beach in Florida, fully protected from creditors because Florida is one of those states with an unlimited homestead exemption. It's one of the attractive things about living in Florida. No state tax and then unlimited homestead exemption. So I don't know if everybody on this call is old enough to remember the OJ case, but when OJ lost the second lawsuit against the Goldmans for wrongful death, they got, I think it was an $11 million judgment against him. He had a home in Florida. They were unable to reach the home in Florida, even though they had this massive judgment against him. And that's because of the Florida homestead exemption. Texas also has an unlimited homestead exemption. And then there's some other states that have been changing recently to actually try to attract people. And so, the homestead exemption is actually shifting nowadays. And you just have to check. And you can, I can post a link or send a link later. I have an article on all the different states and the various homestead exemptions that they have. It's very interesting. California is of a particular note because a lot of people live in California. California homestead exemption has historically been exceedingly low, 125,000, 150,000. It was just almost nothing. But a few years ago, they raised it. It was around 600,000 adjusted for inflation, and it was based on the median value of the home in your county. And so, today it could be upwards of seven or $800,000, depending on where you live. Still, seven or $800,000 is not much of a home in California, but it's something, right? It's better than nothing. So homestead is number one. Number two would be your qualified plans, retirement planning. Similar to the homestead, the government doesn't want you kicked out of your home and they don't want the creditor to take all your savings. And so if you have a federally qualified ERISA plan, like a 401k or a defined benefit plan or something along those lines, that also is protected. So again, to go back to OJ, I like this example because he had two main assets, home in Florida and an NFL retirement plan, which was a defined benefit plan, which was a ERISA plan and therefore protected from creditors. So, they couldn't, even though there was a judgment against him for millions of dollars, they couldn't collect. And he was able to take his 10,000 a month or whatever he got from his retirement plan and spend it and live in his home in Florida. So these are big, and best practice is actually to make sure you understand your homestead exemptions, make sure you understand your qualified plan exemptions. IRAs also are protected in most states. They're not as unqualifiedly protected as the federal plans are. IRAs are state driven, not federally driven. So some states are better than others. Again, California is a particular note. California basically says, hey, the judge has discretion on an IRA. So if the judge's determination is that you need that money to retire, it's protected. If the judge determines you don't need that money to retire, it's not protected. So again, depends on the circumstances. Most other states, I would say, IRAs you can consider fairly protected. There are a few other types of unlimited or exempt assets. Yeah.
Isn't life insurance one of them?
Well, that's the next one I was going to mention. You're
Yeah.
exactly right, Buck. So life insurance is a really big one because imagine if you can have unlimited cash value in your life insurance protected from creditors under exemption planning. That's fantastic. I mean, not only do you get all the benefits of life insurance, the tax deferral or tax free, but you have asset protection. Again, state driven. So California, not so good. Arizona's good. Texas is good. Most of the other states or many of the other states are unlimited in the protection of life insurance. So, I have clients call me all the time and they say, hey, I want to talk about asset protection. My first order of business is to go through their assets, make a determination of what the exempt assets are. And I have had many, many times, I can say, well, you don't really need any asset protection. You're already protected because your assets are really consisting of a homestead, a qualified plan, and life insurance. And those are all protected. So nothing more to do.
If you started it, I mean, obviously there's always the conveyance issues, right? But, say somebody's got some convertible life insurance and they convert that into permanent and start putting that, cash into there, is
Yeah.
that going to be an, illegal transfer? Or I mean, like, whatever you call that,
Fraudulent conveyance.
fraudulent conveyance?
You mean if it's done after there's been a lawsuit or
Well, I
some
know,
type?
like, a lot of people have like convertible insurance, so
Mhm.
the insurance is in place, but to convert it into like permanent, you basically just push a switch and put money in there.
Yeah. So it's a great question and it'll all depend on the timing. So, and it's not the conversion so much because when you convert the insurance, you probably have to still add cash to make it have a cash value, right?
Right, right,
So it would be the adding of the cash that could determine whether and in some cases it might be, let's say you have a cash value policy with $1 million in it, then you end up with a lawsuit and then you try to stuff another 2 million in there real quick. That extra 2 million could be the problem,
right,
not the original million.
right.
And you do have to be careful with that kind of stuff because if you try to take an asset and jam it into something that's exempt, you could taint the part that is exempt. So, be careful anytime you're moving assets after a threat has materialized or a lawsuit has been filed.
Yeah.
Just want to be careful.
Although and you're going to get into this later, but if your trust is the one that owns the life insurance in the first place and there's money in the trust, then that's a separate.
Yeah, it's a separate issue. Yeah, yeah. I mean, if the insurance and the assets of the trust are all owned by the trust, then it wouldn't be an issue. Yeah. So that's the way I like to approach it. Let's look at what you already have. Let's look at the free. What we don't have to do anything. We don't have to make any real effort to do. Sometimes we do start moving a little things around just to make sure that the exemption planning is perfected. That they got it right. Um, but that's first order business. Only then, once we look at all the exemption planning and make a determination that, okay, there's still more assets, we still have another $2 or $3 million or more that is not going to be able to fit inside the exemption plans. Now we move to asset protection. And so when we talk about asset protection, as it has become known in the legal profession and in the legal world, we're talking about legal tools. So we're talking about limited liability companies, limited partnerships, corporations, and trusts. Those are kind of the main things that we're talking about when we're talking about asset protection. And so we can kind of build a whole plan based on understanding those tools. Um, the first order of business on the asset protection side legally is to look at all the assets and divide them into safe assets and risky assets. Safe assets are assets that, by and large, don't create any risk. So your bank account is a pretty safe asset. Your gold bullion is a safe asset. Your cryptocurrency is a safe asset. Your stocks and bonds and all those things. And I see you're smiling. Safe as in it's not going to create risk. Not safe as in it might not lose all its value. That's a different story. Yeah, crypto is by no means safe investment, but it's a safe asset, right? Nobody's going to trip on your wallet key and sue you because, oh, you have an asset called crypto. And so safe assets are good because since they don't create risk, we can kind of put them together. We can put them in a single entity. Whereas risky assets create risk, and therefore we don't want to just throw them all into the same LLC. So risky assets would be real estate. It's risky. People can trip, fall, it can catch on fire, it can injure people. All sorts of things can happen on real estate. Cars, uber risky asset. Cars are the most risky asset, frankly, that most people own. Airplanes, boats. I mean, if it has a lock, a key, a propeller, a door, anything like that, it's considered a risky asset. Risky assets could have nothing but risk, like a jet ski. I don't have my clients calling going, oh, I want to protect my $40,000 jet ski, but it has massive liability potential. That's one way an asset could be seen. Or it could also have a lot of value, like my apartment complex, my rental, my eightplex that is worth $4 million, and yet there's risk in it because there's tenants. So we take the uber risky assets that don't have a lot of value, like your jet skis, and we just try to keep them away from everything. And that means either we leave them in your name, which is counterintuitive, because you'd think, I don't want it in my name, or we put it in a separate LLC that's kind of the toy LLC. So I have a lot of clients that have a toy LLC. They put the boat, the ski boat, the jet skis, and all the stuff that could injure people but it doesn't really have a lot of value. We put it in there, and then it's just out of the way. For the stuff that has value and is risky, we use LLCs, but we segregate them. So this is where the question comes for most people. Say, well, Doug, I'm into real estate. I've been working with Buck for years, and I have all these properties and syndications and so forth. How do I divide them all up? The general rule is that if you have a real estate property, you would have it in a separate LLC. If it's got enough value, like $400,000 or $500,000, I would say that property would be in its own LLC. And if you have a second property, start a new LLC. And so you just keep stacking LLCs next to each other, not on top of each other, just next to each other. If you have some smaller, lesser value real estate, let's say it's $100,000 of equity and you have 3 or 4 little small rental homes in Tennessee or something, you could actually combine them into a single LLC, simply because there's just not enough value to justify having more than one LLC. Some people say, I want an LLC for every single property. That's not wrong, but if you end up with 40 properties, you're going to have quite a long list of LLCs. Other people like to bunch them up and just pick an amount of equity that they're willing to risk in a single LLC. That's my preferred method, is to encourage my clients, pick a level of equity that you're comfortable with risking in one basket, and then just stack up the LLCs in that basket.
With Doug, with this LLC, with LLCs and protection and stuff, a lot of that depends on the state too, doesn't it? I mean, like how much protection does an LLC really give you in the state of California, for example? My understanding is that they're not very useful in terms of charging orders and things like that.
Yeah.
Could you talk about that and maybe ways of circumventing?
Yeah, yeah, and that's a great question. So it's probably best to kind of talk about how an LLC protects it all. And you mentioned charging order. That is the mechanism which an LLC uses to protect assets, is what's called a charging order. So I'll compare it to a corporation. So if you have shares of Tesla or Nvidia or Apple or whatever stock you might like, those are C corporations. And what you get as an owner of that is called a share. It's a share. It's a certificate that says I own X shares of this company. Those shares, if you have a creditor, are seizable. Creditor can reach those shares. A judge can say, "Hey, you owe this guy $1 million and you have all this Tesla stock. Let's just take your Tesla stock." It's an asset just like any other asset that you hold. And so that means that if you hold corporate stock and that's the only thing you have, it's not asset protected from a creditor. Creditor can reach the stock and take it. That's also true with a regular corporation that has the S election. So an S corp, same thing. It's a corporation. Those shares can be taken by a creditor. An LLC and a limited partnership are different. They are member or partner entities, meaning you don't have a share of stock that represents your interest in an LLC. You have a membership interest. And so, just like a membership to a country club or any other member organization, you can discriminate. So you can discriminate and say, hey, look, you can only be a member of this country club if you live in this neighborhood. Sorry, it's for the peoples in this neighborhood. So if you buy a house here, you can be a member. Or if you want to be a member of the flying club, you have to be a pilot. So there's the ways with memberships where you can say only these types of people can be members. With an LLC, we can do the same thing. We can say, hey, the only people that can be members are people that have been approved by the existing members or the organizers. And here's some people that can never be members, creditors of any of those people. And so you can discriminate against creditors when you have an LLC. So that means that someone sues you and your only asset is this membership interest in the LLC. And let's say the LLC has $10 million in it, but all you have is this membership interest. Your creditor cannot get to the $10 million. They can only get to a lien against your interest. So their remedy is called a charging order. And so that's what makes an LLC protective. Now, is that enough? Well, the answer is not always, because a charging order is the exclusive remedy in some states. It's not the exclusive remedy in other states. And California is one of those other states where a charging order is not the exclusive remedy. What that means, Buck, is that a creditor in California against a California LLC may be able to get the judge to foreclose on that LLC and distribute the asset, and in other words, breach the LLC. Again, in California, there's a lot of discretion left to the judges to determine if they can or they want to break into something, whether it's your IRA or an LLC. So you have to be careful. Now,
Oh, wait. Just for clarity, though, is that like when you're talking about California? Obviously, those are of interest to me. But
yeah.
is it because it's a California LLC, or could could they just as easily break into an LLC from a Wyoming or
Mhm.
Texas LLC where there are stronger charging orders?
Right, right. That's a really important question. So the answer is that all the states are a little different. California is not a very good state. Wyoming is a good state. Nevada is a good state. Arizona is a good state. But the problem is that it depends on what the asset in the LLC is. So let's say you set up a Wyoming LLC because you read somewhere that's the best state. And so you go online, you go somewhere, you set up a Wyoming LLC, and then you take it to California and you put a bunch of California property in it. When a judge in California is hearing the case and looking at the asset, which law is that judge going to apply?
Right, California.
California.
But if it's, limited partner shares or stocks or crypto or whatever, I mean,
It's different.
it's different.
Exactly.
So then you
Yeah.
really are protected if you had a Wyoming LLC and somebody try to sue you in California per se.
Well, maybe, because remember, California is very aggressive in how it sees its long arm reach, how it sees what it's allowed to do. So definitely, if you're holding California property, I'm going to say that California courts would almost always apply California law. They're not going to be dissuaded by your Wyoming LLC. That being said, California has also proven they're pretty aggressive if you're in California. So let's say you have a Wyoming LLC, you put a bunch of crypto in there, and then you get sued in California. Would a California judge breach the Wyoming LLC? Very likely the answer is yes. And so, even in a better state, having the LLC may not dissuade a California judge because you're in California. And by the way, if you have a Wyoming LLC in California, and you have a Wyoming LLC and it has nothing to do with California except that you're the member and you happen to be a California resident, then guess what? That Wyoming LLC is now sucked into California. You have to pay the franchise tax. You have to file the tax forms in California, and the judge could easily use that to apply California law. So, so I would not trust a California court applying Wyoming law or any other state when it comes to even an asset that's not in the state. And we've seen that with California, even with trusts and the nings and the wings, where people are trying to move assets out of California and not pay California tax. That California's been very aggressive at putting their arms around that as well. So um so there's no guarantee. The other thing is even if you do everything right, a judge could just ignore the LLC altogether. Say, oh well, we're just going to consider it your alter ego. You didn't treat it like a separate business, so we're just going to pretend it didn't exist at all. Or a judge could say, we don't like the fact that you put assets into it, last year, and this thing that you're accused of being guilty of happened also last year. So we're going to say there was a fraudulent transfer into the LLC, and so we're going to disregard it or suck the assets back out. So LLCs are good. I like them. I use them a lot. I mean, a lot. However, they're just the first tool. And what they're really good for is segregating assets. So the one thing that I have seen LLCs withhold very well is the segregation. So if I have a client with 15 properties and he has 15 different LLCs, and one of those LLCs gets sued for whatever, slip and fall, a mold claim, it doesn't matter. I have never seen a judge go up and go back down and get into one of his other LLCs. So they're very good at segregating from asset to asset. They're like pigeonholes for each asset. And that's what I use them for. I use them to segregate assets. They're also great, again, for risky assets. Businesses are risky. They have customers, they have contracts, they have all sorts of things. So usually a business will also be in a separate LLC. And so LLCs is the first step. And we're going to look at a client's net worth and their situation. And we're going to say, okay, do they have any LLCs already? Many clients do because somebody has told them they should. Some clients don't, and they just never did anything, in which case we're going to say, okay, here's our recommendation for how many LLCs you should have and what assets should go into them. Then the question becomes, okay, once you've figured that out, who holds the LLC? And you mentioned, are they really strong? If they're single member, but the single member is the person, the client themselves, are they going to really hold up? Well, the answer is that it's mixed out there whether they're going to hold up. My answer is that there's no reason to do that. There's no reason to put you as the single member of an LLC. You're better off using your holding company. And so this begins the layering of the asset protection. So at the initial layer is going to be the LLCs. Above that is going to be a holding company. Now, the holding company, we have a choice. We can use another LLC in a state like Wyoming or Nevada or one of the other good states. We can use a limited partnership in one of the other states. My personal preference is a limited partnership, and I like the jurisdiction of Arizona because it's very strong, exclusive charging order remedy. And there are some other benefits with respect to the statute in Arizona, which I like, particularly when we get to the third stage, which is the asset protection trust. So the holding company, let's say we're going to use the Arizona Limited Partnership as the holding company. The holding company is going to hold the membership interest in the LLC, and it can be the single member. Why are we comfortable with the holding company being the single member when I just said if the single member is the individual, it might weaken the LLC? Well, the reason is that the holding company is a multi-member entity of its own right, and it's also a charging order protection entity. So it's not just you, the client, it's another entity. And the reason we'd want to make the LLCs at the lower level single member is just to simplify your tax reporting. Single member LLCs are disregarded for tax purposes. That's a huge advantage because now you're not going to have 15 tax returns with 15 K1s leading up to a holding company return. You're going to have 0 tax returns at the lower level. Even if you have 15 properties, all the accounting will get done at the holding company level, which in this case, in this example, is the Arizona Limited Partnership. And so you have one federal 1065, which is going to generate a K1, and that's going to end up on your personal 1040. So you do have an extra tax return, but in my opinion, that's a good thing. That's what you want. You want that extra tax return because it's
When,
giving you that separate identity.
one question in terms of the holding company, um, say there's a holding company and one of the LLCs has some sort of, operating business or whatever in it, and it gets sued. What kind of exposure is there at the holding company level to creditors?
Yeah, that's a great question. So if one of the LLCs gets sued, does it expose the holding company? The answer is you'd have to pierce the corporate veil at the LLC level. So that's a huge challenge right there. A lot of people talk about piercing the corporate veil like it's just something that you can blow through. It's not. It's a very difficult thing to do. I've seen many cases where clients have been attacked on that exact issue, where it has not been pierced at all. It's just not something that you can just blow through and pierce. So not that much risk generally. Now, that being said, if you have an operating business that's particularly risky, let's say you sell nutraceuticals online, I would not put that in the same holding company as I put all your other real estate holdings. So we will segregate even the holding companies into separate. So I have many clients who will have a holding company for the real estate assets and all the real estate LLCs, and a separate holding company for the operating entity assets, the operating businesses, because those are two different risk profiles. Real estate is risky, but it's not nearly as risky as being a surgeon or being an accountant, or operating even a store on an Amazon store. I mean, all those things carry more risk than just owning a piece of property.
Right. And I guess in hmm, yeah, well, we'll get back to that. I guess when you talk about trust, there's a couple of questions I want to read to you.
Okay.
One from Matt. I've set up several partnerships where I am member in a California LLC that is the general partner in a California LP. How should I structure my partnerships in the future? I'm going development in California. I'm going
Okay.
to do development in California.
Okay, so Matt, it sounds like what you're doing is you have other investors in your partnership, and so you're the general partner, and you're using a limited partnership. That's pretty common for syndication type deals, is to use a limited partnership. That's one of the advantages of a limited partnership. Limited partnerships are dictators, whereas LLCs are democracies. And you might think, oh, I want to be in a democracy. No, you don't. If you're the dictator, you want to be in a dictatorship, as long as you're the dictator. So a limited partnership is the preferred structure for a syndication type deal, and an LLC as the general partner is the right way to do it. So if I understand what you're doing properly, Matt, you've actually set it up the way that you probably want to set it up. Now the question becomes, what else are you doing in that general partner LLC? I have seen people use the same LLC across multiple limited partnerships. When one of those went bad, now the whole LLC is tainted and it has caused problems with his others. I would not reuse the same LLC on different deals. So if you set up a deal and you set up a limited partnership and then you set up an LLC as the general partner, I wouldn't use that LLC again as the general partner in your second deal or your third deal. And I hope that answered the question. If not, please type in a clarification and I'll answer it further.
He has a question too. He said
Yeah.
that's a position. When does it make sense to form a PLLC uh, tied to a professional license over an LLC when forming an entity for a business? I have a medical consulting entity that is a PLLC. I'm about to launch a healthcare adjacent wellness business and trying to decide if it's important to choose the PLLC or the LLC for this entity.
Okay. That's a really good question. So the PLLC is really, it's not so much a choice as a requirement. So if you're a professional, you have to use the PLLC because it's a professional. If it's not a professional business, if it's an adjacent company, you're selling vitamins or supplements or whatever, I would use an LLC. I would not use the PLLC unless you're required to use the PLLC for licensing purposes. In other words, for your physician practice, you were almost certainly required to use the PLLC. So LLC is preferred unless you have to use the PLLC, which is the professional designation. And then be careful, and this is really important. I talk a lot about this with when I talk about taxes. When you do an LLC, you have a choice of how you want to tax it. Um, the legal structure of an LLC is one consideration. The taxability of it is a completely separate consideration. So when you set up an LLC, you can tax it as a disregarded entity, which is if it's a single member LLC, it's automatically going to be a disregarded entity. You can tax it as a partnership, which is the way that 99% of the people are going to want it taxed as a partnership. You can tax it as a corporation, which means a corporation taxation means double taxation, corporate taxation, corporate filing tax return. That would be useful, for example, if you were going to do a 1202 company, a company that qualifies for 1202 treatment. So when you sell the company, you get $10 million of tax-free gain. Or you can do it as an S corporation, which is electing to tax it as a corporation and making the S election. The S election is very critical, though. If you're going to do that, you want to be very careful. Do not put any assets, particularly assets that you're going to depreciate, in either a straight S corporation or an LLC taxed as an S corporation. Because if you do, and I have these clients call me once in a while, somebody said my accountant usually told me to set up an S corp every time I bought a piece of real estate. They come to me with this $10 million portfolio of real estate, and it's all in S corps. The minute you take a piece of property out of an S corp, it triggers the gain on it. It's a taxation issue. So you really do not want to use S corps for anything that holds any assets. You only want to use S corps for an operating business where you're going to take a salary and take the balance as a dividend to avoid the FICA FUTA tax. So S corps really have one use, and that's for an operating business in which you're working in it. Other than that, I would not recommend an S corp anywhere in your structure. C corps have uses as well, usually just one. So in a complicated structure for a client that's really kind of has a lot going on, we may have one C corp or one LLC taxed as a C corp, one S corp or an LLC taxed as an S corp, and then everything else is going to be partnership taxation or disregarded entity taxation. That's why it's very important when you're setting up an asset protection structure that your asset protection attorney is also really well versed in taxes. Because I have seen asset protection attorneys that kind of get the asset protection right, but then the taxation wrong, and the structure is backward. It doesn't work well.
Just so people know, Doug has a master's in tax as well, so that answers that question. And if anybody had,
Yeah, yeah.
um,
I don't know. That was like a torture. Oh, I want more law school.
so I think to this point, like we've got this structure, I think people can kind of visualize where you've got these LLCs that, over time, you may end up adding a holding company. Each one
Mhm.
of those LLCs, if it's you basically make it a single member LLC that's owned by the holding company so that they can all just get disregarded and move up to the holding company, right?
Correct. Yep.
And at this point, I think is this the right time to talk about who owns the holding company and how to structure that? Or is
I think so. Yeah. I mean, from there, now we have to say, okay, who owns the holding company? It could be husband and wife, in which case, your planning is at an end. it's now pretty good. It's a two-tier structure with LLCs and a holding company. Or if your assets are sufficient, and by sufficient, I mean a couple of $1 million or more, then I would not stop at the holding company level. I would add what's called an asset protection trust. And in the world of asset protection trust, there's some options, but I'm going to explain the most common options. You can do it as a fully foreign asset protection trust in a jurisdiction like the Cook Islands or Nevis or Belize. You can do it as a fully domestic asset protection trust in a jurisdiction like Wyoming or Nevada or Alaska or Delaware. Or you can do it as a hybrid between the two, which is called a bridge trust. And we'll talk about all three so you understand kind of the pros and cons. Because as with anything, there's no right answer for everybody. It depends on your circumstances and what you're trying to accomplish.
One of the things
So,
I think would be helpful for you to
yeah,
explain to people, Doug, is the concept of trust,
yeah,
just in
okay.
general, because, I think people think about like, well, what is a trust doing? Is a trust separate from me legally?
Hmm.
Is it
Hmm.
truly a separate, what does the law recognize, a person or a trust or, that kind of thing?
Yeah, yeah. That's really good because you're right. Even attorneys who don't practice in this area are often confused by what a trust is. So, a trust is not like an LLC. You don't go and register it with the Secretary of State. You don't have to go and check to see if the name is available. A trust is actually not an entity at all. It's a contract. So a trust is an agreement. So when you see a trust, it will usually say trust agreement because it's just an agreement between a few parties. So the parties are the person who would like to create the trust, meaning let's say it's me. And I say, hey, Buck, I know you're going to take your kids to SeaWorld. I'd love it if you take my kids with them. And so I'm going to give you $500, right? So buy their tickets, buy their food, stuffed animals. That would be awesome. Whatever, but no soda. My kids don't drink soda. And if you see the friend of my son, Jimmy, my son owes Jimmy $100. Do not give Jimmy the $100. That's between them. We're not going to use this money for that. If you agree to that, then we've just created a trust. So I am what's called the grantor or the trustor, meaning I'm the guy who wanted to create the trust. You, in this example, are the trustee. You're the person who's responsible for the money. So you get the $500 to go to SeaWorld. The beneficiary is my son because the $500 is for him. And then we also added a couple of things on that example called spend-through provisions. Spend-through provisions are basically what you can and what you cannot use the money for. So you can use it for the entry fee and food and stuffed animals and rides and whatever. You can't use it for soda and you can't use it to pay Jimmy the debt my son owes him. Right. So I've said, hey, restrictions on that. Here's a limit to what you can do as the trustee. That's a trust. And that's it. And frankly, that's legal. Even an oral trust like that would be considered legal. It is not in that sense an entity, but an agreement. Now, we wouldn't, of course, use an oral trust with a client. We would always write it down. So you're going to have a trust deed or a trust agreement, which is going to specify all those parties to the trust. Everybody is going to be clear as to who they're doing, what role they're playing, and what their obligations are in that role. And then because trusts have been around for so long, and I mean before this country ever existed, we had trusts because it is coming from Old English common law when you would entrust land to someone to farm the land, but they didn't own it. They were entrusted with it. So this whole concept of a trust is very, very old, which is good because it's very well trodden. We know exactly how the courts see trusts and treat trusts. And because they're so widely used, the IRS had to get involved and say, okay, well, somebody's still got to pay the tax, right? So let's figure out how to tax trusts. And so there are different ways to tax trust, and basically similar to the LLC where you have an option. The trust is either going to be trust taxed to me, the grantor, the one who created the trust. It's going to be taxed to my son, the beneficiary, or it's going to be taxed to itself. The trust itself has its own set of tax rates. And so it will never be taxed to you, the trustee, in your role as trustee. You're just a fiduciary for the trust. It's not, there's no role that says you have to pay the tax, but you could be responsible for filing the trust tax returns. And so we're getting a little broad here with getting into the taxation of trusts. But to answer your question, a trust is really just an agreement. Um, but what makes trusts so powerful, Buck, is that they're incredibly flexible. Like I could say pretty much anything I want in a trust. I could say, hey, I'm going to give my daughter, X part of my estate, but only if she doesn't marry this guy. In fact, only if she marries one of these two guys. Only if she gets a degree in biochemistry and works for something that will take us to the moon. I mean, you could make up any crazy stuff you want and say these are the things that would be required in order for you to inherit inside of a trust. As long as it's legal, you can put it in there. The benefit of this is that when it comes to asset protection, we can have a really, really clear set of spend-through provisions, which basically say, hey, these assets are never intended for my creditor as the trustee, as the trustor, the grantor, your creditor as the trustee, my children's creditor as the beneficiary. None of those creditors could ever reach the assets of the trust. And so every state has some type of trust statute which defines what you can and cannot do inside of a trust. And that's where we get into asset protection trusts.
Can you just briefly talk about, the different, because, people, I think, frequently have simple living trust,
Yeah,
right?
most often. Yeah.
And if you, and I think if you could sort of differentiate that kind of trust versus the type of trust we're talking about, so people kind of have a framework of what we're actually talking about and how it's different from their living trust.
Yeah, that's a great place to start because okay, so when it comes to trust, let's just get the taxation out of the way. A living trust is one of those types of trust that it's taxed to the creator of the trust called the grantor. From a taxation standpoint, that is absolutely the simplest form of taxation is the living trust, a grantor trust. Living trusts by their nature are grantor because of one word, and that word is revocable. So any trust that's revocable is automatically a grantor trust. That's just the way it is. Because if you can revoke it, then it has to be taxed back to you. The other thing that revocable does is it pretty much guarantees that that type of trust cannot be an asset protection trust. Because it's revocable,
Right.
if you tried to put spend-through provisions in a revocable trust, the judge could just look at it and say, well, these are cute, but revoke it. And as long as you've retained the power to revoke it, then your spend-through provisions don't do anything. So, revocable trust is what most people have for estate planning, and they are very good for estate planning. They're the preferred type of tool when it comes to estate planning because they do avoid probate. They do give you immediate access, your successor trustee, to reach the assets of the estate and pass them to your kids or whatever you're doing. So they're very powerful, but they are not asset protection vehicles. They do not have any asset protection to them because of that revocability. When we get to an asset protection trust, we are now talking about an irrevocable trust. Now, this gets confusing because people say, well, an irrevocable trust, I mean, I'm not ready to give my assets away. I might need them for retirement. Because they think irrevocable means you're now giving the assets away. In an asset protection trust, the trust is irrevocable, but you remain the beneficiary of the trust, meaning the assets are still retained for you. So you are irrevocably giving them to a trustee for your own benefit. And this may sound a little counterintuitive. And up until 1984, this was not actually even allowed. And this is where we get into the Foreign Asset Protection Trust, because the Cook Islands in 1984 passed the Cook Islands Trust Act, which specifically statutorily allowed for the creation of a self-settle, and you're creating it for yourself, irrevocable trust with spender provisions. And that was the birth of the Asset Protection Trust. It was a little controversial for the first 10 or so years because attorneys here just said, I don't understand. How can you have an irrevocable trust for yourself and protect it against creditors? The answer in the Cook Islands was, well, because we said you can by statute. Read the statute and you can see that we said you can. Many attorneys commented that this is not going to work. The U.S. government is never going to let it work. We're going to pass some kind of statute that says you're not allowed to do that. You're not allowed to opt out of this legal system. What's interesting is that the opposite happened in 1989. I'm sorry, 1998. Alaska passed the first domestic asset protection trust statute, and they allowed for the exact same thing, a self-settled spendthrift trust. And so, quite the opposite of the states going and saying you can't create a foreign asset protection trust. We actually created a whole series of domestic jurisdictions, and there's now 20 plus domestic jurisdictions that allow for an asset protection trust. And so now you have both foreign asset protection trusts and domestic asset protection trusts, all authorized under statute. And this is really important. If you want something to be clear, draft a statute because you can set exactly the rules for how it works. And Cook Islands drafted a statute, Belize drafted a statute, Nevis drafted a statute, all sorts of about 24 jurisdictions offshore drafted a statute. Alaska also drafted a statute. Wyoming followed suit. Nevada followed suit. Delaware followed suit. Even Tennessee and Alabama followed suit. So we now have lots of statutes to choose from. Then the question becomes, okay, what's best? And again, if you're talking about protection, pure protection, just nothing but the strongest possible protection, there's really no question that the foreign asset protection trust is going to be the strongest. The reason is that there is no jurisdiction in the U.S. So if you set up a trust in the Cook Islands or Nevis or Belize, you have a trustee down there, and then you put $10 million in it and you put that in Switzerland. If a judge determines you're liable, even if they say that transfer to the trust should be revoked or invalidated or it should be disregarded, they have no jurisdiction to actually go and get that money. And that's what makes a foreign asset protection trust so strong. But there's a downside to that, or I should say a cost to that. Foreign asset protection trusts have a lot of compliance. There's Form 3520 and 3520A, which are very serious IRS forms that must be completed every year. Failure to complete that form is a massive penalty as a percentage of trust assets, like a third of the value of the trust if you fail to file that form. It definitely hampers your tax strategy planning because foreign trusts have restrictions on what they can own. It's still a grantor trust, but it's just a much less flexible grantor trust. You are also not going to control that trust directly. You should not control that trust. You're going to have a foreign trustee, and the cost of that is going to be higher. Most foreign trusts are $40,000 to $50,000 or more to set up. But more importantly, and my experience has been really clear, that foreign trusts to maintain even a simple one, $10,000 to $15,000 a year, and I've had some at the $40,000 and $50,000 a year level. So they are incredibly strong. But for the average person out there, I would say a foreign trust is a little bit overkill from a maintenance standpoint. There's a big headwind to it. The average life of a foreign trust is fairly short. I've been told by the chief counsel of one of the leading trust companies down in the Cook Islands that the average life of their trusts are about 4 years.
Meaning
So
people just get sick of paying for everything and they just shut them down.
yeah, most of the time what happens is they set them up when they're feeling a little stressed or they're feeling like there's something. And then after 3 or 4 years, when the issue has gone away, their accountant is saying, hey, this is a lot of maintenance, this is a lot of cost, and they shut them down. So I'm for foreign trusts. I use them extensively, but I don't think every tool is appropriate for every person. And just because it's the best, I mean, a Ferrari might be the best car if you want to go really fast, but it's not great if you want to go camping with your kids. So it's not about best in some ultimate stand. It's best for you in your circumstances. So I would say in my personal experience, about 5% of the time, a fully foreign trust from day one is best. 5% of the time. The other end of the spectrum is the fully domestic trusts. Like I said, these are the Nevada, Delaware, Wyoming, Alaska type trusts. Simpler in the sense that they're not foreign, so they don't have the foreign trust compliance, that 3520 and 3520A, which is so serious. But they still have loss of control. They still do have tax return. And the biggest problem I see with the domestic trusts is that they don't hold up as well because They are not sitting in the Cook Islands where the statute says that they cannot recognize any U.S. courts. They're sitting in Nevada where the statute says they must recognize U.S. courts. And by statute, I mean U.S. Constitution, which says, hey, states must grant full faith and credit to the laws and judicial proceedings of the other states. So we have case law on this, so we can have a pretty clear roadmap. And there's plenty of case law where the domestic trusts have not worked. In
What's
other
the
words,
point of even doing them anymore then? Like if they've been turned over, if they've
yeah.
been ineffective, why would anybody do that?
Well, I still don't think they're worthless. I think if you live in that state, let's say, if you really are trying to protect against a certain type of risk that is likely to be covered, if you're doing it well in time, well before there's any issues whatsoever, and you just feel more comfortable in the state, I would say a domestic asset protection trust is at least something you could consider. Um, if it's between a domestic asset protection trust for a client that has 2 or 3 or $4 million and a foreign asset protection trust, a domestic trust might be the best choice because the foreign trust really is expensive and has a lot of compliance. So there are times where you might consider it. In my personal opinion, I've not actually ever set up a fully domestic only asset protection trust because I think there's a better option. And
And that
that's
might be the bridge trust.
that's the bridge trust. That's right.
And just so
That's
people know, I have a bridge trust. So and one of the reasons I wanted y'all to know about this is I think it's a great tool for, people who are thinking about having these higher level protections like foreign asset protection, but also need to, also want to keep costs contained and frankly, just have a lot more flexibility on a day-to-day basis. So, yeah, why don't you tell us about that, Doug?
Yeah, so I mean, my question was pretty simple when I designed this 30 years ago. Hey, I love the foreign asset protection trust, but I know that a lot of clients are just going to self deselect from that. They're just going to say I'm not comfortable. Especially 30 years ago when I started this, offshore was kind of taboo. I mean, it was very uncommon, and people, back then it was a little bit like, oh, offshore, that's got to be some kind of tax scammy thing. And frankly, it was. There was a lot of tax scams going on, and that was not. There was a lot of bad press. So I said, look, if it's between not doing anything or doing a foreign trust, and 90% of the people are going to say I'm not comfortable with foreign trust, how can I get that level of protection but keep it simple? Fortunately, as you mentioned, when I was doing that master's in taxation at NYU, I had access to the people who wrote the tax code. I mean, most of the professors there had a hand in writing the 1986 tax code. And so I had just a lot of ability to get the highest level of expertise. And I figured out that I could have both. I could have a foreign asset protection trust, but have it taxed and treated as a simple domestic trust. And so that's what I did. That's what a bridge trust is. A bridge trust is just a foreign trust drafted and registered offshore, but then it's treated as a domestic trust for tax purposes by meeting a two-part test as outlined in 7701A30E of the Internal Revenue Code. And that two-part test is just a control test and a court test. So I meet that test, giving the bridge trust a completely simple taxation with no Form 3520, no foreign trust requirements, but I'm still registered offshore as a foreign trust. So if my clients in the 2 or 3% of the time that they call me and say, "Oh my God, we're going to have to trigger the trust," they need that foreign level of protection. We can cross that bridge, and the foreign level of protection is there. So it's kind of a best of both worlds. You get the foreign protection if you ever do need it in the future. You've already solved the biggest challenge, which is funding the trust timely. So if you set up a trust today and you fund it, you put all the assets in it, and it's a bridge trust, and then 5 years from now, you have to trigger the trust, meaning you have to declare an event of duress, cause the offshore trustee to take the full role of trustee, and then move the jurisdiction of the trust out of the US, drop it. The assets are already there. So we've solved for funding the trust late, which is why you can't wait until you have a problem to set up an asset protection trust or any part of the asset protection planning. You need to do it when the waters are calm. So what the bridge trust allows, it allows us to set up the trust while the waters are calm. But if we need it, we can just cross the bridge, and now we have the strongest type of trust in the world, which is a foreign asset protection trust.
So, one question that like I have on that, Doug, is theoretically, is there no issue with, changing jurisdiction? That's not seen as a fraudulent transfer of some kind itself, just changing jurisdiction from domestic to, the Cook Islands.
Yeah, it's a great question. So when we're talking about fraudulent transfer, kind of got to focus in on what the elements of it are. So a fraudulent transfer is a transfer with an intent to delay, hinder, or defraud a creditor. So the key word there is transfer, right? And intent, of course. So if you make a transfer, the transfer is change of the title. So if you have a property worth $2 million and you get sued and you go, hey, I'm going to transfer this to my kids, that could be seen as a fraudulent transfer because the court can then look at your transfer and say, hey, he probably was intending to do that because he got sued. And so now they can reverse the transfer. But in the case of a trust, the transfer occurs when you fund the trust. In other words, when you set up the trust. The fact that the trust itself changes jurisdiction is not a transfer. So I'll often give the example of, let's say you have a house in the mountains, up in the hills of San Diego, right? And you park your McLaren up there, and you get an alert on your phone saying, hey, wildfire, you evacuate. You're going to run up there, grab your McLaren, drive it down to your office in downtown San Diego, and keep it out of the way of the fire. You have moved your McLaren. You have moved the asset out of harm's way. You have not transferred title. You didn't run out and give it away. You just moved it. And so the same is true with the trust. Just because the trust decides, hey, I prefer to bank in Switzerland and I prefer to have my trustee sitting in the Cook Islands, not a transfer from a legal definition standpoint, therefore not a fraudulent transfer.
Yeah.
Now, let's just say a judge doesn't understand that. And it's totally possible this judge could not understand that. As crazy as that sounds, it is possible that a judge could not understand that legal distinction. And the judge says, well, I don't care. It feels to me like a fraudulent transfer. I'm going to deem it a fraudulent transfer. Well, the question then would be, what's the remedy of the judge? They can't force the Cook Islands trustee to do anything. So you still solve the problem.
Um, just so people understand, I think this is helpful to visualize because it sounds very, very complicated, but in reality, the function of this thing is quite simple. If you remember Doug's description of the LLCs, and then you have the holding company, the only thing here that's different is that instead of you or your spouse or whoever owning that holding company, now it's the trust
Mm-hmm.
owns the holding company. So you may say, well, now I'm going to have to deal with the trustee every single time I have a transaction. Well, in practice, that's not the case at all. In fact, what ends up happening is you're the manager of your holding company and you're the manager of all of these other, LLCs. So when people talk about owning nothing, controlling everything, that's what they're talking about. And so the money flow is actually very simple. All the entities they're not sitting in Switzerland. They're just on your Chase account or whatever, just as if you were doing any sort of transaction. So even though the structure is sort of foreign potentially and complicated, the actual function of it is not challenging at all. And even for distributions, obviously you make distributions from the holding company. It's not like you're locked in. I mean, one of the to your point, Doug, I think I've brought up these kinds of things to friends before, and they're like, I'm just not ready to give away my money and never use it again. Well, that's not
Yeah,
what you're doing here. That's
correct.
just, you're just not controlling it. And obviously, you can make distributions to yourself because ultimately you're the beneficiary anyway, right?
Right. Yeah, exactly. You're the just like with the revocable living trust that most people listening have for estate planning, you're the beneficiary of that trust. Same is true with an asset protection trust. You're the beneficiary. So the trust is designed for you. You're not giving your assets away at all. That's why it's still a grantor trust. And again, from the standpoint of taxation, all that means is it's disregarded for tax purposes. So the bridge trust doesn't even file a tax return. It's just a zero on there.
Right.
It all ends up on your personal 1040 return, which is what you want. That's kind of the simple structure. So you end up with even if you had, let's say, 15 LLCs, one holding company, and a bridge trust, you're talking about one tax return with a one set of K1s to your 1040. That's it.
So Matt's asking, how do you know if a bridge trust makes sense for you? A certain net worth, or is it more determined by risk profile of the assets in the trust? That kind of.
Yeah. Yeah. So it's a great question, Matt. The answer is asset level, risk profile, and risk tolerance. Those are the three considerations I look at. So asset level, somewhere around $1 to $2 million of assets that are not protected by the exemption planning that we talked about earlier. That's enough to start considering a bridge trust. If you're in a high risk profile profession, like you're syndicating real estate, for example, or you're a physician, or if you're doing anything like that, that makes it even more. But yes, a bridge trust would be the right approach. And then, of course, your own personal risk tolerance. I mean, I have clients with just a few $100,000 of assets that have a full bridge trust because they can't even imagine losing any of it. I have clients with $50 million of assets that are kind of like, eh,
And
whatever.
there's not like a bunch of maintenance costs either. So that's kind of
Yeah.
the thing is you set it up and, you know,
I mean, there is maintenance, but it's very simple.
yeah,
It's fixed.
minimal.
It's not 15 or $20,000 a year.
Right.
It's easy. Um, so I would recommend Matt, if you want, um, just to schedule a call with me. I'm happy to go over your situation with you.
What else do you think we ought to know about this, Doug? I think it's one thing that's helpful to understand too. This is not estate planning.
Right.
Yeah. Can
Right.
you just explain sort of that different level? Um, there's sometimes
Yeah.
confusion on this. You still need
Yeah.
estate planning.
There's a lot of confusion on this part. So, um, again, trusts have different purposes. When you're talking about an asset protection trust, including a bridge trust, you're not talking about planning the estate. You're talking about protecting the assets. You're still going to want to have and take advantage of your revocable living trust or an estate plan, even if it's a will. And the estate plan could be really simple, could be as simple as a just a will. It could be as complicated as, two slats, a bunch of irrevocable trust for kids. You could have a very complicated estate plan. So the way we work is we work hand in glove with your estate planning attorney. Most of the time, it's really just a one phone call and a document connecting the two trusts, because the way it works is that the bridge trust pours into the estate planning trust at your death. So we keep the jobs separate because estate planning has some state considerations. There's all sorts of things that you want to get right about in your state. And so we're not going to try to do that at the bridge trust level.
Yeah.
Want you to do that at your estate planning level. And so, we work with attorneys in every state and we connect our bridge trust to it. So you're just going to fund very differently though. So if you only have an estate planning consisting of a revocable living trust, your estate planning attorney is going to tell you put everything in it, your home, your real estate, your LLCs, your holding company, your crypto, everything, your investments. So everything is in your estate planning trust. That's fine if you die, but if you get sued, now everything is in the very trust that has no asset protection. When you combine asset protection and estate planning, what we're going to say is nothing goes in the estate planning trust, everything goes into the asset protection structure. And then at your death, we're going to pour it into the estate planning.
What, Doug, why don't the estate planning trust provide much asset protection? If those trusts have essentially taken, you're taken possession of those assets and they don't belong to you, why are they still exposed?
Well, because of the revocability of the estate planning trust.
Right. So unless you had a separate, you
Yeah.
know, irrevocable estate planning.
Then it would protect. Yeah, correct. Yeah. So let's say you have a SLAT, right? It's a spousal lifetime access trust, or you have, some type of trust where there's a completed gift and it's part of your estate planning. Those types of trust will protect assets.
Yeah.
It's the revocable living trusts that don't protect assets, and buck 99% of the trusts that people have on this call are going to be the revocable living trusts.
Yeah. Yeah. Absolutely. Um, Anything else we ought to know? There's no other questions here. We've been going for an hour or so.
Mm-hmm.
Um, is there anything else you want to mention before we give your information in?
No, I mean, my advice again is just have a conversation with somebody who understands this. The best thing you can do is inform yourself so that you understand, okay, this is where I'm at. Again, many times once you understand your exemption options, you may not need to do anything extra, or you may just need an LLC for a few assets. Um, the goal is really for you to understand where you're at. I don't really I care what level of assets you're at. I would encourage a conversation with
Yeah.
someone, me or like me, where you can say, "Hey, this is where I'm at. I've just started my real estate investing. I've got 2 properties and I just kind of want to know where I'm heading." I love those calls because those are the people who want to get it right from the beginning. Or whether you've been doing it for 20 years and you got a whole bunch of assets and now you're like, "Oh, geez, I might be exposed." It doesn't matter. Wherever you're at, I would encourage you to just get the knowledge and information so that you know what you're building into in the future.
Yeah, and I would just say that, I mean, I would highly recommend anybody. I mean, listen, what's interesting is, by the way, everybody who joined this call is still on. Uh,
Oh, good.
and this is stuff that people just, I think it's like, trying to buy health insurance after you have like a diagnosis of something bad. Don't wait for something bad, folks, because stuff happens. And anyway, it's worth a call with Doug and figure out where you're at. I mean, you've got like, I mean, people know Doug everywhere. Even in Montecito, I mentioned Doug Lodmell, and people know who Doug Lodmell is. And he's sitting
Really?
on a call with you and basically willing to share his time on a one-on-one. So take advantage of it. So it looks like, Doug, you put a link here for
Yeah.
booking. Obviously he's doing this for free for us guys, so take
Yeah.
advantage of it. And also, if you don't, if you can't figure out that, you can also just reply to any of my
Yeah.
emails about this, and I'll just directly send you over to Doug. This is something that I just think is really important. And I think Doug's a great guy, and I really think that him having his support is of value to everyone here. So certainly take advantage of it. Anything else, Doug?
No, it was great. This is a really good talk. We went a little deeper and a little,
Yeah.
than we normally go because your questions were really insightful. So you got experience. So you have real world with this. So that's good.
Unfortunately, yeah. Right. Great. Well, thanks everybody for joining, and I'll send this out as a replay as well. So,
All right.
bye bye.
Thanks all.